Welcome back to the Deep Dive. If you've been following the market headlines, you've probably seen the S&P 500, the Nasdaq. They're all flashing green, hitting recent highs.
Right.
And that sounds great, like a booming market, right? But the reality is a lot more complex.
It really is.
Today, we're strapping on the headlamps and going deep beneath the surface, way away from the bright lights of the megacap winners. Our mission is to find those quiet, high-probability breakout stocks that, the retail crowd is just missing.
And it's necessary work right now. I mean, we have to face this reality check. The market rally is extremely narrow.
So narrow.
While the indices look great, the underlying participation is, well, it's terrible. We're seeing metrics consistently showing fewer than half of the individual stocks are actually in on the move.
Ouch. That's the classic sign, isn't it? A market that's fundamentally sick underneath a cosmetically healthy index. It's what we call poor market breadth.
Exactly. And that concentration, that narrowness, it's a classic warning signal. It tells you the gains are being driven by a tiny handful of, extremely large companies.
The usual suspects.
The usual suspects, mainly in tech, AI, and the semiconductor space. And while those big names have powered the index up, they're also super sensitive. They've recently given background because of valuation worries, economic jitters. It just creates this massive volatility at the top.
Which can lead to really rapid corrections.
That's right.
So if the headline sectors are messy and the indices are fundamentally misleading, that brings us to our mission. Where is the smart money, the institutional capital, actually flowing to find a stable setup?
We're looking for evidence of accumulation in less trafficked areas. Our goal is to find those specific pockets showing stock-level volume spikes that look like institutional buying.
The real money.
The real money. The kind of flow that happens outside the crowded AI trade. We are hunting in, let's be honest, boring but essential sectors.
Boring is good right now.
Boring is great. Think real-world infrastructure, enterprise cloud software, and select pockets of semiconductors and fintech that support these massive ongoing capital expenditures. These are the names the retail crowd just overlooks. They don't have the glamour of the Magnificent Seven.
That actually leads us perfectly into the opportunity that exists beyond those screaming headlines. It's fascinating because that retail fixation on the mega cap AI winners, it actually creates a vacuum.
It does.
And that vacuum gives us two distinct opportunities.
The distraction is the golden key. I mean, because everyone is watching NVDA earnings or the latest DOJ filing, smaller stocks can just consolidate. They shake out the weak hands and build these really strong technical foundations.
So opportunity number one is purely based on size, right?
Precisely. We're focusing on smaller and mid-cap names. They're just not monopolizing the spotlight. And that reduced attention lets them form very clean technical bases, flat bases, cup with handles, without the kind of wild daily swings the big caps have to endure.
They get to consolidate quietly.
They get to consolidate quietly. And that consolidation is preparation for a powerful move.
And opportunity number two is sectoral. This is where the fundamental story meets the technical setup. So let's talk about why infrastructure is the focus now, beyond just the technicals.
Well, it connects to the bigger macro picture. Institutions are looking years out, not days. Infrastructure spending, whether it's for data center power grids, 5G, essential cloud plumbing, it's largely non-cyclical.
It has to happen.
It has to happen. It's often backed by government initiatives or these long-term corporate debt cycles. Unlike the big cap story, which relies on future AI profit margins, infrastructure names are cashing in on current capital spending.
So when we see that quiet accumulation, these foundational areas, infrastructure, cloud infra, those specialized chips, the breakout isn't just a random pop. It's got real momentum behind it.
Exactly. When you see a stock in one of these forgotten sectors forming a beautiful base and then it starts to break out, that's often a reflection of large institutional buying before a major news cycle.
They're getting in ahead of the story.
They are. Institutions are inherently forward-looking. They're positioning capital based on deep research long before the press releases hit. By the time it's public, that initial move is often already priced in. We're just using volume analysis to spot their tracks.
Okay, that brings us to the mechanics. We found a quiet name that's forming a beautiful base. Now what? We need confirmation that it's actually ready to run, not just fool us. Let's establish the core rule for entry. You need at least 2 of the 3 confirmation criteria. This is your essential breakout checklist.
And this filter is critical. It prevents the #1 mistake traders make, which is chasing a shallow move. If you only meet 1 criterion, you're basically speculating. 2 out of 3 gives you a high probability.
Let's start with checklist item number 1, the pattern itself. What shapes are we looking for? What defines a clear buy point?
We need a textbook technical pattern that shows compression. So we want a flat base, a clear cup with handle, or a multi-week consolidation that has been tightening up.
The tightening is key.
That tightening price action is crucial. It shows volatility is being squeezed out, and the buy point must be definitive, clearing a clear area of prior resistance. We want to buy strength, not chase desperation.
Okay. Checklist item 2, and this is the big one, the signature of institutional intent. Volume. How much volume is enough to confirm that the big money is actually involved?
Volume is the financial footprint of conviction. The breakout day must show volume at least 1.5 times, but ideally, 2 times or more its recent average trading volume.
And why that specific number, 1.5 to 2 times?
Because that level of demand cannot be sustained by retail traders. It just can't. It requires institutional commitment, a hedge fund, a mutual fund, a pension stepping in and saying, we want a large block of this stock right now.
And what if we see a price pop above resistance, but the volume is just, it's weak? That's a false breakout. That's a red flag telling you the move is driven by speculators, maybe some short covering, but not genuine institutional support. If you see weak volume, you hold off.
Don't jump in. Don't jump in. You wait for a retest back to the breakout level to see if it holds, or you wait for volume to show up on the next couple of days. Patience here saves a lot of capital.
All right, now for the final confirmation layer, checklist item 3, relative strength and moving averages. This tells us about the quality and the underlying trend of the stock relative to the whole market.
The stock needs to be demonstrably stronger than its benchmark index. It has to show a rising relative strength, or RS line. The RS line just tracks how well the stock is performing compared to, say, the S&P 500. A rising line means that even when the market is weak, the stock is holding up better.
And what about the moving averages? What are we watching for the price action to clear there?
Price needs to be clearing the 50-day moving average. That's your intermediate trend. And ideally, holding support at the faster trend lines, specifically the 21-day and 50-day exponential moving averages, or EMAs.
Why the 21 EMA specifically?
The 21 EMA is a commonly watched moving average by institutional traders for active trend following. If the stock is respecting those technical supports, the trend is likely intact.
Before we move on, you added a crucial caution about the RSI. What is the relative strength index, and why should we be wary if it's too high?
Good question. The RSI, the Relative Strength Index, is an oscillator. It measures the speed and change of price movement, so it's really an indicator of momentum. It goes from 0 to 100.
Okay.
If the stock's RSI is extreme, let's say above 80 at the point of breakout, it often means the price is overheated. It's due for an immediate, quick pullback, even if the overall setup is good. We want momentum, but not, manic enthusiasm.
Right, a controlled burn. Okay, that's a deep dive on the entry. But the foundation of any successful trading is risk management. What are the strict stop and sizing rules we need to enforce before we even place the trade?
Risk management starts with position sizing. You should risk no more than 1 to 2% of your total capital per trade.
Per trade?
Per trade. So if your stop loss requires you to sell 10% lower, you size your position so that a 10% loss only equals 1 or 2% of your total account value.
And where exactly does that initial stop go?
Yeah.
It can't be arbitrary.
No, it's dictated by the pattern. Your initial stop needs to be placed just below the low of the technical base, or the low of the handle if you're trading a cup with handle. If the stock breaks that critical support, the pattern has failed. You exit immediately.
And for traders who want to reduce their initial exposure,
scaling in on confirmation is an excellent strategy. Take a smaller pilot position, and if the breakout holds for a day or two on volume, then you can add size up to your full planned allocation.
excellent. Now that we have the mechanics, let's look at the specific high-probability candidates flagged in your research. We've got a dual approach here: larger, cleaner institutional plays, and then some smaller, under-the-radar names with potentially asymmetric returns.
Let's start with the larger names. The institutional commitment is usually clearer there, and the volatility is a bit more managed.
Broadcom, AVGO, was flagged as a potential high-conviction institutional play. What's the rationale there?
AVGO is a massive, diversified player. It has exposure to networking, software infrastructure. Both are critical to the AI build-out. It's not just a pure chip play, it's the plumbing.
Right.
And it has already shown professional-level breakout behavior, which tells us institutional buyers are already involved. Our watch point is simple. Look for it to clear short-term resistance on expanding, 2 times average volume. That's likely to trigger fast follow-through.
Next up, MRVL technology, MRVL. another key semiconductor and infrastructure name.
MRVL is focused heavily on data center interconnects and custom ASICs, the infrastructure backbone of advanced computing. It's consistently appearing on screens that are looking for stocks tied to the real hardware build-out.
And technically.
Technically, the base is building nicely. The institutional money wants exposure here, but they need the consolidation to finish. We need to see that clean base breakout confirmed by heavy relative volume.
Okay, Datadog, DDOG. This gives us a great play on cloud infrastructure and observability. Why is DDOG showing up now?
DDOG is a leading observability platform. As cloud spending stabilizes and major companies optimize their environments, the need for systems like Datadog's only grows. It represents a classic mix of technical breakout potential combined with strong secular growth.
And the tradable level.
It's highly tradable on a clean breakout above its recent consolidation area, but only if that volume confirms the move. That would show that institutions believe the cloud spend slowdown is reversible.
And finally, Coinbase Global, Coin. This one comes with a much higher risk profile, but it's often a beneficiary of big institutional swings.
Yeah, Coin is flagged because of its high liquidity and frequent volatility, driven by macro crypto sentiment. It is definitely higher risk, but it's essential infrastructure for the crypto economy.
So breakouts are possible.
Institutional-style breakouts are possible after a long consolidation, but given the volatility, sizing is absolutely critical here. If you use the right sizing, the momentum moves can be very significant.
Now for the under-the-radar names, where returns might be asymmetric, but the swings require surgical stops. Let's talk about Verisign, VCYT.
VCYT is a small cap in the diagnostic space. It's often flagged for undervalued potential and low float. And low float stocks, they amplify moves when institutional money enters.
So extra caution needed.
Exactly. Because it's smaller, it needs an even more definitive flat base and serious volume confirmation. We have to stress using smaller sizing here, because if the trade goes against you, the move can be rapid and brutal.
An impinged PI.
PI is interesting. It combines an industry catalyst RFID technology with clear technical consolidation. If it prints a clean base with that volume confirmation, it's worth monitoring closely.
Are there others in this category?
Generally, yeah. We are also finding selections in other small cap infrastructure peers like Vertiv, a data center cooling specialist. These low-float essential names often break quietly before big moves, but again, their volatility requires extreme risk management discipline.
Okay, we have the stocks and the criteria. Let's outline the practical trading process. How do we turn this watch list into daily action? What's the routine?
It starts with discipline. Scan daily for maybe 20 to 30 names that meet the base and tightening range criteria. This is just the idea generation phase.
That's the first filter.
Right. Then you filter those down aggressively by looking for rising relative strength and expanding intraday volume before the breakout even happens. You want to see the volume building at that resistance level.
And setting alerts is crucial to avoid chasing a spike.
Yes. Set alerts at the actual buy point, the specific prior resistance level, but then set a secondary alert 2 or 3% above that buy point. That way, if it pops quickly, you avoid jumping in after the move is already extended.
And if it does spike on low volume?
You wait. You wait for either a retest or for additional volume on day 2. Never, ever chase.
And finally, managing risk once the trade is active.
It's a dynamic process. Use your initial stop below the base low. But once the trade is running, you have to trail your stop. You can use the 21 EMA as a guide, or if the stock has had a massive run, a simple 15 to 20% trailing stop works.
And the rotation plan.
Discard weak setups daily and reallocate that capital immediately into the names that show genuine follow-through on day 2 or 3. Be ruthless with what's not working.
Moving into our final segment, let's talk about the danger zones. We've discussed the immediate red flag, failed confirmation on low volume. But what about external macro shocks that can just derail a perfect technical setup?
You have to be aware of the calendar. Upcoming Fed announcements, critical economic data, or company-specific earnings misses that just contradict the narrative, they often turn beautiful breakouts into painful traps.
So technicals are conditional.
Completely. They rely on the underlying narrative remaining intact.
And here's where we return to the core thesis of market narrowness. We're being highly selective. But what happens at the index level that should tell us to reduce risk universally, even if our individual trades are working?
We have to watch for divergence. This is the crucial market level warning. It happens when the major indices like the S&P 500 make a new high, but the advanced decline line deteriorates significantly.
Okay, let's clarify for the listener.
Mm-hmm.
What is the advanced decline line and why does this deterioration matter so much?
The advanced decline line, or AD line, is simply a running tally of the number of stocks that rose versus the number that fell each day. It's the simplest, purest measurement of market breadth.
So it's the health of the whole army, not just the generals.
Perfect analogy. If the S&P 500 is going up, but the AD line is falling, it means those gains are being carried by a handful of megacaps, while the majority of stocks are actually declining. That divergence is the market sending a clear signal. Participation is dying, and the rally is running out of fuel.
When you see that divergence elevated index deteriorating AD line, what's the immediate action?
You immediately reduce leverage, you reduce your overall portfolio exposure, and you favor smaller position sizing across the board. You don't fight the overall lack of participation.
You stay selective.
You stay highly selective, and you only deploy significant capital when you see that institutional volume confirmation in sectors everyone else is deliberately ignoring.
So what does this all mean? The core lesson here seems to be that in a narrow market, successful trading really comes down to disciplined filtering.
Absolutely. The two fastest, most effective filters to separate real breakouts from all the noise are volume confirmation, that 1.5 to 2 times rule, and relative strength. They force you to follow where the capital is flowing, not just where the headlines are screaming.
That is actionable knowledge that respects the risk in this concentrated market. As we wrap up this deep dive, let's leave our listeners with one final thought to mull over.
Consider this. How much market noise is generated just by the sheer focus on the easily accessible headline stocks, the media coverage they get?
All of it, basically.
Right. By rigorously focusing on volume analysis, you are effectively tuning out that noise. You're forcing yourself to pay attention to capital flows in boring but essential sectors like infrastructure and cloud plumbing. So the question you should ask yourself is, why are sophisticated institutions quietly accumulating these foundational names now, while retail investors are obsessed with the daily swings of the latest AI chip news? That volume divergence, it's often the first signal of the next massive multi-year market theme.